All right, rock stars, I want to share this quick video or this presentation with you. I just taught this to a group of EXP agents that we do, but I thought this would be relevant information that this can help us in this current market. So just gave a brief overview about how the secondary mortgage market works because everybody's wondering what's going on. We got all kind of cliche phrases out here about why somebody should marry the house, date the rate, divorce the landlord. And I added in there, don't cheat on your realtor and lender. So the secondary mortgage market, how it works, I mean, lenders and banks, we lend money to borrowers. Then the bank lender ends up releasing these funds to our quasi-government entities on the back end, Fannie Mae, Freddie Mac, and Ginnie Mae for government loans. And then they sell what's called mortgage-backed securities. So they sell the securities to investors, right? Well, the Federal Reserve is one of the biggest investors in mortgage-backed securities, or at least they were. So the Fed does four different things: manage inflation, supervise the banking system, maintain stability, and provides banking services. So when the Fed changes their rate, they're changing what's called an overnight rate for lending. So it does not it does not directly affect mortgages. However, it affects overall monetary policy, so there is some trickle down. So if the Fed changes the rate and how much it costs to borrow by 0.75%, that does not mean mortgage rates have went up by 0.75%. The biggest thing we need to understand about what has happened in the last 2 years, we have what was called quantitative easing, right? So the Fed jumps in to make sure that the liquidity is still in the market for lending. As a result, the last 2 years, we've been in what's called an artificial market, right? I think it's a watershed moment, a one-time event where rates dipped below 3% for a period of time. So what did that cause? They were buying mortgage-backed securities so much that rates went down to keep liquidity in the housing market, and a lot of people took advantage of that. But what happened? We really didn't have enough supply for the demand that this actually caused. So some people think it's good or bad. So it really depends on your take. I mean, the last 2 years were good as far as housing is concerned, but now we're seeing the bad part of quantitative easing versus just letting the markets play out. Before the pandemic, rates were already trending to be in the high 4s, 5%. And if we'd have just let the market play out, we possibly would be where we are now, but the way they've done it. So they pulled the rug from under us. We had our Fed chairman, Jerome Powell, say he doesn't know how to curb inflation. Yeah, he has his hands thrown up. He had a speech on August 26th. He said pain to the American people over 10 times in that speech. What happens when we hear pain? Our mind goes into fight or flight. We have the macro news media too that is playing into this fear. So we're telling people it's still a good time to buy, but they're like, why? He's saying he's going to cause pain and he's going to inflict that on us through a policy called demand destruction. So the only way to curb inflation is to slow down the supply and demand. So he's going to make the demand be lower by making the cost of everything actually be higher. So demand destruction, unfortunately, again, something that sounds very negative, actually is what we need to happen. So just think of it as we had a Fed chairman that made an artificial interest rate market by quantitative easing and also pumped trillions of billions of dollars into the economy during the pandemic. So you have a double-edged sword. We already had inflationary times, and then we pumped more money, the most money I think ever in history, put into the market to be used. And what do? We consume, we consume, we consume. So when that happens, prices actually go up based on the supply and demand. So you have more demand, not enough supply. Meanwhile, we have an artificial interest rate market. And now he's acting like he's turned into, the arsonist, right? Those are things where arsonists almost. He flamed the fire. Now he wants to be a firefighter and try to hurry up and put it out. So these things have grown over the 2-year period, and now they want to get control of it, but it's too little, too late. Now, will they get control of it? Absolutely. But the way they've gone about it, they should have been on top of it way sooner. Like I said, it's like an arsonist now trying to be a firefighter and wants to put this fire out quickly, but it's not going to happen because of the way it has been handled up to this point. When they were doing these rate increases to the Fed funds rate, we started off really small, a quarter here, 0.5 here. No, we should have went all in, just like they went all in with buying the mortgage-backed securities and keeping that market as an artificial market for that 2-year period. The good news, though, is that we're in recessionary times. They have not called it. It really doesn't feel like it because people are still spending money. And that's why he wants demand destruction to make us stop spending money or slow down the amount of money that we're actually spending. But good news, the last 5 recessions we've seen from peak to trough that rates have actually dropped. So hopefully there is some good news at the end of the tunnel. But we also know that these are unprecedented times. Been in the business for 20 years, never really been through a market like this, but don't worry, folks, we will actually survive, right? So you can't really foresee things that are bucking logic, right? So we have an artificial rate market, we have rates go up, we have all this money pumped into the economy, but now when we want to stop buying the mortgage bonds and let the free market the mortgage-backed securities, let the free market work as it should, just pull the rug out versus easing from out. They just pull the rug. It's always one side, to the other. But we didn't see the Russia and Ukraine thing on the horizon. And like we said, we didn't see that, okay, mortgage-backed securities are being propped up, the economy is being propped up. So it defies logic in what should actually happen. But I still am holding that history will remain true, that while we're in recessionary times and they go through this demand destruction, that rates will come down. Because as a general rule, when inflation is low, mortgage rates tend to be lower. When inflation is high, rates tend to be higher. And we have red hot inflation that they're trying to get under control. And as they actually do that, even if it's in a destructive way, it's going to benefit people. So that's why this date the rate part of it, although sounds kind of corny and cliche, really is actually true, right? So actually dating the rate for this period of time and getting through what's so-called pain. Why would a buyer still buy right now? Because they're going to get to lock in the price. And I know that affordability is actually a challenge. Because of that, we probably lost about 30% of the buyers that were looking to buy because of affordability. Overall, we've seen that mortgage rate payments have rose about 50% across the country. So this is a macro number that was put out by NAR, and I wonder what it is actually locally. I'm sure I probably could do some type of data analysis and see what that difference looks like. However, everything costs more, but guess what also costs more is rent. So I was on an Instagram live with one of your colleagues actually, and they said something very relative to why we need to coach buyers to still be in the market, because at the end of the day, what's the alternative, right? Prices gone up, rent's gone up, it's still going to go up. So it's just a decision of, finding that right spot as far as budgeting is concerned and getting in where you fit in and still buy a house. But you have to be able to qualify that with data, because we are fighting against an actual government, well, not government, a news media that is based on fear. So when people say pain and they see fear, what do? We retreat, right? But buyers that really want to buy will come back out and actually buy a house. Let's look at something real quick. I skipped that one slide because it's not really relevant, but the average price around here is about $475 in Woodbridge. If the rates were to continue to slide, I mean, here's the difference in this middle column between 6% and 7.25%. So there's overall a difference at the highest level to the lowest level, about $400, right? So we can find ways to budget $400 if it's really important, right? So we need to show why it's important to get on the home ownership bandwagon right now and at least lock in these prices, because if we continue with the appreciation, then those numbers start to be higher. So if you're going to rent, pay a mortgage or something very close to it, why not be paying your own? So we just need to keep that in mind. But here's the good news at the end of the tunnel. So these numbers are always about 30 days behind. So they're still predicting that we will see rates drop back down into the 5s in Q4 and the beginning of 2023 Q1. It's hard to believe to me that we're already at the end of the year. Seems like time has passed. But if history repeats itself, and I know that the markets are not acting with logic, hopefully we will see what is presented here. So people that get in will possibly have an opportunity to, refinance. at a later date, but they will at least have locked in the price because we're still seeing price appreciation. Just the amount of appreciation has decelerated, not a market crash, a actual correction, which we needed. I mean, you need to correct a train that's going 1,000 miles per hour and probably should only be traveling about 100 miles per hour, if that. So 3 things buyers can do that we should encourage them about is, of course, expand their search area and criteria. So maybe that first house is not the dream house. It doesn't have everything you want, but you still get your chance to get into home ownership, or they should, I say. Explore alternative financing. So now that sellers understand that they have to participate, 88% of the contracts that we had over the last 60 days had seller concessions. So maybe using those seller concessions to buy down an interest rate permanently, temporarily, and also looking at adjustable rate mortgages. So these are some things, like I said, if there's a will, there's a way. Can't let people have fear and sit on the sideline. And then the other one, which I never thought I would say, is to use grants. Gift funds, money from the government or state entities that are helping with buying a house, using those grants and gift funds to possibly, buy down a rate and take advantage of those programs to keep your cash, and maybe use that cash to fuel the difference in payment that you might have from rent, or slightly higher than when rates were actually lower. So have to be creative. And as realtors and lenders, the things we should be doing right now is gaining market share. Because unfortunately, during these times, a lot of people are going to fall off. It just is what it is. I've been through it. I've seen it for 20 years. There will be less agents in the market, which will allow for you to gain market share as the go-to person that has stayed the course. Educate with confidence. How do you do that? So education is the key to getting buyers off the fence, because we're fighting a macro problem with the news and you're talking from a micro level. So educate with confidence. How do you do that? By listening to videos like this, applying this type of information. If you want this PowerPoint presentation, just send me an email at queen.mortgages@gmail.com. And last but not least, folks, we got to work. Right? Double down on the activities. It was taking us 1 out of 4 buyers to get a pre-approved person to go. Now that is 1 out of 7. Part of it is, always has been issues with maybe credit, not the right time, houses to sell, of the like, but now it's also an affordability. So some people just can't afford to buy right now. So we have to double down on activities, but be unattached to the result. And I know that's very hard to do, right? But consistency with activities over time, you'll be one of the ones that come out on the other side, because, hey, right now, it is so important to be working with a modern mortgage advisor such as myself, because you need strategies, discussions, and planning are in place during these times, right? So housing, although we're going to have some challenges, it's the first sector to slow, but it's also the first one to rebound, and we still want to be in the game when that actually happens. So, all right, y'all, thanks for listening. Like I said, if you want this presentation, reach out, go out there, get after it. And as always, I'm here to help.